Hello financial fans, welcome back to another stock analysis. Today we'll be covering Costco stock ticker COST. Costco is a membership-based retail warehouse chain that provides a wide selection of merchandise at discounted prices. It operates in various countries across the globe. The company offers a wide range of products including groceries, electronics, clothing, furniture and home goods. Costco also offers services such as photo processing, gas stations and pharmacies. They also have a food court inside the store where members can grab a bite to eat a variety of items that can be purchased in bulk. Members pay an annual fee for the privilege of shopping at Costco's warehouses, which are typically much larger than traditional retail stores and offer more limited selection of products, but at lower prices. Costco's business model is based on volume sales and keeping overhead costs low, which allows them to pass on savings to their members. They currently are operating 847 locations and their market cap is sitting at $221.1 billion. In 2022, they generated a revenue of $226.95 billion and the dividend yield is sitting at 0.73%. 40% of their income is generated from food and sundries, 29% from non-foods, 14% from fresh fruits, and 17% from warehousing and other income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from the margin of safety. The first ratios that we'll be looking at are the EBIT growth and the margin growth. The EBIT has grown from $3 billion in 2013 to $7.8 billion in 2022. The average growth in EBIT during this period was 11.3%, meaning no change in our margin of safety. The margin has also grown, going from 2.9% in 2013 to 3.4% in 2022. The average growth in margin was a very nice 2.05% average margin growth, meaning a 5% deduction from a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from $1.24 a share in 2013 to $3.60 a share in 2022. The average growth in dividends during this period was 12.6%, meaning a 10% deduction from a margin of safety. The payout ratio is also still sitting at a very nice 26.4%, meaning another 5% deduction from a margin of safety. The final two ratios are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Costco, it's just under 1 year, in this case a 93% debt to EBITDA ratio, meaning a 5% deduction from a margin of safety. Return on invested capital is sitting at 15%, meaning another 5% deduction from a margin of safety. Looking very good so far for Costco. Let's go look at the valuation models next to determine the intrinsic value for Costco. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2022. The average growth in cash flow during this period was 61.47%, and I've gone with a 10-year expected growth in free cash flow of 17.5%. With this percentage, we can determine the future free cash flow and determine a terminal year of valuation for Costco using a perpetual growth rate of 3% and a discount rate of 8% to make it the present value. The sum of free cash flow then is determined, sitting at $171.7 billion. Then to get our equity value, we have to add the cash and equivalents and subtract the debt. Doing this, we get an equity value of $162.6 billion. And to get our discounted cash flow price per share, we have to divide it by the amount of shares outstanding, which is 443.73 million shares. Then out of this model, we get a discounted cash flow price per share of $366.64. And with the current price of $498.30, we had a downside of $131.66, which is a 26.5% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends during this period was 12.13%. I've gone with the expected growth rate for the future dividends for Costco of 8.3%, and we'll be using a discount rate of 9% once again in this valuation. Then out of this model, we get a price per share of $556.97. And with the current price of $498.30, out of this model, we get an upside of $58.67, which is almost a 12% upside. The final model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Costco, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 29.04. All we have to do to get our fair value here is multiply it by the amount of earnings per share that Costco is generating, which in this case is $13.23 a share. Of this then, we get a fair value of $384.24. And with the current price of once again $498.30, here we get a downside of $114.06, which is almost a 23% downside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation prices per share. Out of this, we get an average of $435.95 a share. A margin of safety we have determined earlier, using a standard margin of safety of 25%, deducting 5% for the debt to EBITDA, deducting 5% for the margin growth, deducting 5% for the return on invested capital, deducting another 10% for the dividend growth, and another 5% for the payout ratio, leaving us at a negative margin of safety, meaning that I would pay a premium to own the stock. In this case then, applying this margin of safety, we got a fair value of $457.75, and with the current price of $498.30, this leaves us with a downside of only 8.14%. So in this case, I would consider it a sell, but it's very close to fair value. If there's any other dividend companies that you would like to see me cover on this channel, please let me know, and thanks for watching.